You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Live via iPhone, I'm Don McDonald. For some reason, my high-tech connection thing isn't working very well. We got it to work for Tom, but we couldn't get it to work for me, so I'm on the phone, and we'll be like the same. You and I will sound similar now when you call us at 855-935-TALK, 855-935-8255. So stop by. Now, you know, on occasion, we have taken Robin Hood to task, not the one with the Merry Men and Little John and, Friar Tuck, but the app, the trading app, because we think it encourages people to do dumb things. Well, in today's Wall Street Journal, Jason Zweig wrote about spending time as a trader on Robinhood.
And Jason is someone who lines up with us about being a buy and hold investor, being diversified, keeping your costs low, not timing markets, not chasing hot stocks or trends or any of that kind of thing. Jason very much goes along with the things that we tell you here every single week. But he decided to take the deep dive into the lights, the excitement, the loud sounds, the screaming alerts.
Wait, was it a deep dive, really?
No, maybe not.
It was $100 dive.
That's true. He's not. He's still going to make the mortgage payment this month.
Wall Street Journal's money.
I love that. We're going to try that, by the way. We've got to expense it, see what happens.
They can't afford to go with 1,000 WSJ. You get the big bucks. Well, I decided that I was going to try it, too. If Jason can do it, I had never done it. I'd never been on Robinhood. So I signed up today. And it is like a video game. I see why people play on it. It's really cool. It's got, like, for example, I was watching Bitcoin, of all stupid things, because it's right there on my main screen. And it has this three-dimensional chart and a little line, and it flashes, and there's all kinds. It's like a video game. It's
or
addictive.
Casino.
A casino. It's a lot what it looks like. And that's what Jason Zweig said. He said he got kind of hooked up. He got hooked on it, and he said his discipline just kind of flew out the window. Like,
and I'm not going to do it because I have an addictive personality. I'd be scared to do it, that I would like it, and then that would be the end. I'd be trading my way to attempted nirvana.
Well, here's what I'm going to do. I am going to create a disciplined, non-disciplined approach to trading stocks on Robinhood. We're going to make this a weekly thing on the show. I have put, of my own money, by the way, not Vestry's.
Yeah, don't try and expense that, mister. I'll be knocking that one down.
$100. I put $100 in my Robinhood account right here on my iPhone. And then what I decided I was going to do, instead of like Jason Zweig trying to pick momentum stocks, I decided, why try to pick them? I am going to go totally random walk. I'm going Burton Malkiel all the way, or monkey dart throwing. I'm going monkey dart throwing. So what I found online, there is a random stock picker. So earlier today, I clicked on the random stock picker. It gave me a ticker symbol. And I put in a buy at the open on Monday order, market order, for this particular issue. And I'm going to hold it for 1 week, one business week. I'm going to sell it just before the close on Friday. And keep track of how I do with my cyber monkey dart throwing madness or whatever.
I think I really like the McDonald monkeys better, but it kind of a nice alliteration.
McDonald's cyber monkey business.
Yeah, that's
because
not bad either.
There's a cyber component to it, but it's random. So we're just going to play this game. It's kind of like the stock picking game. But I decided to do it that way. That way I'm not trying to be smart. And I'm not going to tell you, any of you, I'm not even going to tell Tom what the stock is that I got from my random generator because I don't want to influence the direction of this game.
And I want to be curious to see how you respond to all the bells and whistles and all the alerts and the green arrows and red arrows and the things that come at you, Jason says, that really get you going, because Jason went into it he was going to use a discipline, and he said after about 3 days he threw it out the window because it's just too exciting to try some of the ideas that they threw at him.
Oh, and they turn it into, it's like a casino. Like I just got this thing that came up on my screen. It says, invite a friend, get a free stock. Not only do you get a free stock when your friend signs up, it appears in your account up to $500, but you also get an entry into a lottery to win Facebook or Berkshire Hathaway or Apple.
Something to look forward to. We'll be watching those Don will be giving us the update every week. Ryan, Matthew, and Lynn, we're coming to you right out of this break. 855-935-TALK if you have a question for Tom and Don here on Talking Real Money.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
For your real life and real future, Tom and Don are talking real money.
Welcome back to Talking Real Money. Tom Talk and Don McDonald. 855-935-TALK. 855-935-8255. Here to answer your questions. And let's just get right to it. Ryan, patiently waiting, and joins us here on Talking Real Money. Hi, Ryan.
Hey, guys. Can you hear me okay?
Hey, we hear you just great.
Excellent. So I have a question, but before I give you guys this question, I've got to set it up with a little context. About 6 months ago, I was looking at the world of finance just as the bottom was falling out from everything, right when COVID was just starting to really hit, the U.S. and sort of penetrate the markets. And I had about $1 million in cash just sitting on the sidelines that I've been just sitting on for a really long time. I won't even tell you how long, because it's a long time. And what I did with that $1 million is, as soon as the market sort of went on its way down, I started buying into index funds. I'm a big listener to your show. I figured, these guys know what they're talking about, so I started buying ETFs. I bought the S&P index, and then I sort of tried to put in some of my own thoughts on the market, and I bought into the Jets ETF. I don't know if you guys have heard of that, but that's basically a collection of all the airline industries. And I'll tell you, I got extremely lucky. I bought into these things right around the second or third week of March, and if you're following these things, this is right when the market hit its low. And what I did was I held these all the way up until now. And what my question is so the other thing I bought was oil, and that was an ETF that also pays a dividend. So those three things, $1 million split three ways evenly into those three ETFs. And so my question now is, I get it. I got extremely lucky. I'm a terrible market timer. I've never been good at it. I don't want to try it again. I've done it in the past. I've failed completely. I need to take some of this cash out to purchase another investment in real estate. My question to you is, if you were me, what would you do right now, knowing where we're at in time and knowing sort of the future? Well, sorry, not knowing the future, because no one can predict the future, but sort of knowing that we've come, we've already essentially gained all of our losses back in the S&P. Oil is still sort of on the downturn. That you look at airlines, that industry, it's starting to tick up a little bit, although we're probably not at full capacity, and who knows, how long.
All right, Ryan. Okay, you painted a good picture here for us. So, but my question to you still would be, out of the $1 million, how much of that money do you need for your next real estate project?
About half of it.
Okay.
About half.
So, and And this, I'm assuming all this money is post-tax, like a brokerage, regular taxable type of account.
It is.
Yeah. So there's two things to consider here. First of all, the Standard & Poor's 500 I do not consider a speculative investment. That is reasonably well diversified. It's among 500 large securities. But when you start getting into things like Jet ETF and oil, those are highly speculative. You made a bet, it worked out. But here's the bigger question. So they're way up, as you pointed out, from April or from March. If you went and sold all of that, you would have a huge tax bill, correct?
Correct.
So, I mean, here'd be my take. If you really said, I want to leave some of it in the market, the money I would leave in the market would be in the S&P 500. If it was, again, my advice would be sell some this year, maybe sell some early next year so that you get 2 years of, you can sort of take the tax hit over 2 years. But otherwise, there's no great piece of advice. I mean, you made a speculative bet on a couple of investments. It worked out. We're very happy for you.
Yeah. And there's no sort of like tax loss harvesting, or maybe could I roll it into a 401k or do some sort of backdoor Roth? I mean, I hear these terms sort of thrown around to help with the tax implications of it. Is there any sort of strategy that I could take advantage of there?
There really is not. I mean, in terms, because here's the only strategy I know of. You either are going to pay short-term capital gains tax rates, which will be at your normal income tax rate, or you're going to pay a long-term capital gain rate. And depending on your income, that's either going to be 15, 20, or perhaps 23%. So if you can stretch it out, not take it, as I said, sort of put off more of it so you hold it for at least a year, you will reduce your tax bill from your regular income tax rate, which is generally higher than the 15 or 20%. So that might be a strategy. But other than that, there is no way to sort of move that to another place, to take that, put it in a 401k or anything like that would avoid those taxes. No.
Got it. Okay, that's good to know. By the way, I heard you guys talking about Robinhood. There's another app out there. You might have heard of it, and I don't work for these guys, so I'm not trying to promote them or anything like that. But I use them because I love their strategy and their what they do. It's an app called Acorns, and what it does is when you buy anything, your credit card, your bank account, they round up to the nearest dollar, and they
thank
put that into
Ryan, we got to go because we have other people waiting. We're very familiar with Acorns. We've been a promoter of Acorns on this program for many years now. Don and I both use it. We love it. I think it's a phenomenal service because what it does is exactly what you said. When you spend money, it rounds up the difference in sort of spare change, puts it right into a low-cost portfolio of exchange-traded funds. It's pretty diversified. I love it. It takes no discipline to invest. Ryan, thank you very much for your call.
It's easy breezy. We love Acorns. On the other hand, Robinhood,
not so
hey, all
much.
Right. I'm back here. It's working for a minute. Go ahead. Who's next?
Matthew's up next. Hi, Matthew. Welcome to Talking Real Money.
Hey, can you hear me?
Yeah.
We hear you very well.
All right, great. Okay, so not a whole lot of money here to talk about, but just need some direction. My wife and I were both 50, and we wanted to be debt-free, which we achieved early on, the beginning of 2020, and we put away $50,000. We want to stay in the place that we're at. We like it, and just kind of cabin in the woods type of deal, but we want to purchase a home. And but we also want to invest. Now, she has a 401k. I own my own business. We're talking combined income, probably $140,000. What would you do to start off and invest? And I mean, how would you first base? I guess is where I'm at.
Well, Matthew, what do we have to invest? Do we have anything right now?
Yeah, we got about we've saved up the last 9 months $50,000. So
and there's nothing else. There's no IRAs. There are no.
He said there's a 401. His wife's 401k.
No, well, my wife has a 401k. Yep.
Yeah.
And I have a sole proprietorship business. So what would you do? Like do an FHA loan, get in 3%, keep the money aside and start a mutual fund or start?
Well, now wait, you're living
wanna...
in the cabin right now. Is that right? The house in the woods.
Yep.
You're living in that?
Yep. We don't have any payments. We're debt free.
So you want to keep that as a second home?
We want to. We want to keep it as a recreational property. I just became a grandfather.
Okay, so you want to be in another house somewhere else.
Right, exactly. I'm not actually calling from Linwood like you mentioned.
Hang on. We'll come back to you, Matthew.
Hang on, Matthew. Let's take a break, and then let's.
Tom and Don are talking real money.
Before you end up buying a financial product that you'll regret later, either call us on the podcast or the show, or if you need a little more time, that's why we offer free meetings with our fiduciary advisors at Vestory with no cost, no obligation, and no high-pressure sales pitch, I promise. Just give us a call at 800-386-3004, or better yet, just set up an appointment at vestory.com, VESTORY.com.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-TALK is our phone number. Give us a call at 855-935-8255. We're talking to Matthew. Matthew has a little house in the woods and wants to get another place. And Matthew, pardon my being a bit of a pain, but I'm trying to get real clear on this. You want another house for what reason?
Exactly. We want to be in between where we're working and we're pretty much too much of a commute. In one bedroom, we'd like a 2-bedroom, a larger house.
How much will this new house cost you? You've probably shopped.
Yeah. I mean, we're looking at the Connor area, so you're looking at, what, $400,000?
Yeah, here's the issue, because, as you said, you're now debt-free. You're not going to be debt-free anymore, but you're going to need a decent down payment. You're going to need a decent down payment, which is going to eat up almost all of your $50,000.
Okay. So
basically, what you need to do is probably save that for your down payment. Then, once you're in the house, you've got all that settled in, then you need to start making regular contributions, as much as you can put away within your household budget, into IRAs or Roth IRAs. It sounds like you guys could do Roth IRAs.
Well, and he's got his wife's 401k. Depending on, by the way, the amount you could set aside, there's a number of things that would allow you as a small business operator to save a little bit more than you could in a standard IRA. That might be worth looking into. I'm with Don. Take the 50, put that in short-term bond fund, high-yield savings account, something like that, so it's ready to go for whatever down payment you're going to need. Put whatever money you may need. I'm thinking, depending on the deal today, I mean, you mentioned the FHA, so obviously that's a much smaller down payment, but depending on the deal, you're going to probably need all that 50 and maybe a little bit more. Have your wife continue to put the money in the 401k, and then once all that's settled, then you could start thinking about ways you could set money aside for retirement in an IRA, a Roth IRA, or as I said, maybe something that has more options to save additionally as a small business owner. Does that make sense?
Oh yeah, no, it does. That's a big help. We're not in a point where, hey, we're going to run out and buy this place tomorrow. It's more like, this is exactly what I needed to hear. So, if we need to save up another $50,000 and it takes 6 months to do, that's fine.
You should do okay. You're going to need the whole 50 though, as Tom said. So, really investing is something you're going to do once you get settled into the new house. You could do a little bit of it on the side, just, a regular monthly contributions, either toward, get a simple IRA or an I-401k or something like that. But for now, keep that money safe for the down payment. Thanks, Matthew.
Thank you very much for your call. 855-935-TALK, 855-935-8255. We're going to talk to Lynn here in a couple minutes. I just want to mention my neighborhood. We don't promote much on the show, as you know. But I'm so proud of our little neighborhood here, because those of you who know me know I live in Maltby. It's a small place. And we have this restaurant called the Maltby Cafe that's been here for like 40 years. And like a lot of other small businesses.
Killer cinnamon rolls, right?
Yeah, the cinnamon rolls are ridiculous. They have these huge breakfasts. It's very popular, but of course the last 9 months have been extremely difficult on the restaurant business. I went in there a couple of weeks. You remember me talking about this, to buy a cinnamon roll for my daughter, and the woman started crying when I said, I hope you guys are going to be okay. I didn't know how dire it was. It turned out it was extremely dire. They were getting ready to shut the business down after about 40 years. Well, someone put up a GoFundMe page for them, the Maltby Cafe, and they've already raised $100,000 there, which they announced today. That's enough. We'll be able, it appears, of course, we don't know what's ahead, but it appears that we'll be able to survive. They, by the way, for a restaurant, they pay health. I think they even said they have a retirement plan. It's very progressive and not very healthy oftentimes, but it's very progressive. So I just want to say I'm extremely proud. You go look at the GoFundMe page. There are people giving $1,000. This is for a small restaurant in the basement of a building about 200 yards from where I'm speaking. So I'm very proud of the residents of Maltby and the area for putting that together.
Jeff Glickman put in $1,000.
Love it. 855-935-TALK. Great holiday story. We'll be right back with more here on Talking Real Money. Thanks for listening.
Tom and Don are talking real money.
There's a science to managing money. I call it financial physics, and you can get a free copy of my easy-to-read book, Financial Physics, at talkingrealmoney.com/free, or there's an interactive version available on Apple iBooks. It's called Financial Physics, that's spelled with an F, and you can get it free at talkingrealmoney.com/free or in the Apple bookstore.
Reality radio for a really great future. We're talking real money.
Welcome back to Talking Real Money. Our telephone number, and we are here live and in person. We want to help you. 855-935-TALK. 855-935-8255. You're laughing when I said we want to help people? How's that funny?
No, you said we're live, and I said sorta.
Yeah, we're trying, but we are here.
Yeah, we are.
It's been trying, and we are trying. So, and Lynn has been kind enough to wait a long time to ask us a question. Lynn, thank you for your patience, and welcome to the program. How can we help?
Thank you very much. Can you hear me?
We hear you just great.
Yes. Okay. I appreciate, and I'm happy to visit with you, Don, and I'm happy to make my acquaintance with you, Tom. Tom, I've listened to you, Don, since the 80s when you were in Denver at KHAL. So, long time.
I'm old. I know.
Me too. You have been my mentor. I've listened to everything you've ever said and tried to follow through with everything you've ever offered. Anyway,
what can we do for you today?
Thank you. Big time lover of Jack Bogle, the founder of the index funds, and when he did that, I moved everything to them. I have basically everything in Roth today. Do have a brokerage account, and that's what I'm calling you about. Sadly, I have grave concerns with the potential of our future political administration and the potential of the capital gains taxes increases. And I just wonder if you all would give any advice as to whether I should rebalance and exchange nearly $500,000 of VTSAX to VBTLX, the bond fund.
So I want to make sure I'm understanding your question. What you're really asking is, it sounds like a couple of things. You don't trust the future because capital gains taxes may go up.
Correct.
And should you be selling stocks and buying bonds? Am I hearing that correctly?
That's right.
Okay. So here's my take on tax policy. Argue with it if you wish. My always take on tax policy is it is what it is today, because we have and yes, Joe Biden has suggested, is promoting the fact that there's a number of things, by the way, that from a taxation standpoint that might be unpleasant to some, that he is promoting. And yes, capital gains tax increase is among them, but I would not make changes in my portfolio based on that. I would never pay taxes until I have to unless you said, look, here's the only reason I'd look at this differently, Lynn. If you said, I've made enough money in stocks, I'm now going to have enough money for my retirement, I want to take some risk off the table, that would be a different thing. And as Don said earlier, under that circumstance, yeah, you pay the taxes, you get on with your life. That's part of making money. But if it was simply because I think the future is going to look like X and I want to make that change, I would not do that. I think that is a poor way to manage your portfolio.
Okay.
And Nan, and Lynn, how long have you been listening to me?
Well, since the 80s.
80s. Okay. Now, do you ever remember me telling anyone ever to sell based on future political or economic situations?
No.
Ever.
No,
Never.
not at all.
I've never said it. In fact, I've told people, no matter how bad it looks, no matter how bleak the future appears in our imagination, it's rarely, one, what we expect it to be, and it's rarely as bleak for as long as we expect it to be.
Lynn, thank you very much for your call, 855-935-TALK. And that's nice that she's listened to you since the late 19th century. I think that's wonderful. No, late 20th century.
I don't look half my age.
You don't really do that. Let's go back to the phones. Nancy joins us here on Talking Real Money. Hi, Nancy.
Hi. I have all of my mutual funds with Vanguard, but I have 3 separate securities that are held with CompuShare, and I'm wondering if I should have Vanguard hold those 2.
Yeah, maybe. I mean, CompuShare is a place where they will hold your individual stock sort of certificates. They'll be the record keeper of individual securities.
They're a transfer agent. Yeah.
Yeah. I would, only for the following reason. Just it makes it simpler to have all of your sort of things like that in one place. You can go online, you can look at them. I have great sense of trust in Vanguard as a custodian. I think they custodian somewhere around $10 trillion. So I think they're pretty sturdy. And I think
we're talking real money again.
Yeah, I mean, so I think that would be a good idea. It sort of cleans things up. It simplifies them, Nancy. It's all there in one place. And there's not going to be any difference between having those securities, frankly, at CompuShare than it would be at Vanguard. 855-935-8255. Give us a call. We'd love to help you here on Talking Real Money.
Tom and Don are talking real money.
Everybody needs help with their money now and again, and if you need more help than we can give in the course of this podcast or show, set up an appointment with one of our advisors for a free actual meeting with no obligation and no high-pressure sales pitch. Just go to vestory.com, that's vestory.com, or call 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
Here every Saturday, and weekdays too, because you can call anytime to 855-935-TALK. That's 8255. If you're like me, you're challenged about all the letters. I'd like numbers better. It's
you're
easier
always
for
challenged
me.
by the letters.
I'm challenged by something.
Every day. We do. We have podcasts pretty much every day at TalkingRealMoney.com, so go check those out.
Please do. Let's go back to the telephones. Adam waiting and now joins us here on Talking Real Money. Hi, Adam. How can we help?
Hi, guys. Thanks for taking my call. I just wanted to ask you about your take on the mega backdoor Roth conversion.
So a backdoor Roth is different than a Roth conversion. So a backdoor Roth goes. Go ahead.
No, I was just going to say I just recently found out my employer allows this. The in-service rollover, they call it, or the in-service conversion. I'd be eligible to put like another $17,000 in. I just wanted to get your take on that. So you work for a larger company, I'm imagining, correct? I do. Yeah. So this is just another way to save more money for retirement. And the idea here is it's going to be post-tax. It will grow, tax-free, basically. I am in favor of it. I think it, somebody's going to say I have the wrong number. But I believe at like Microsoft, you can save up to like $54,000 a year now between, pre-tax, post-tax, and then post like this. I think it's a great idea. I don't know why. $57,000 for 2020 is the information we just got.
I think if again, this goes into your overall planning, Adam. In other words, if it's money that you do not need, your money that you can afford to set aside for retirement, I don't know why you wouldn't do it.
Very good. Very good. Yeah, it looks, I mean, everything, it's not a huge, we wouldn't be making a huge sacrifice to put the 17,000 in there. And if I'm right on your train of thoughts, I appreciate that.
No, and I think again, it really does. I mean, and depending on which plan you're in, you might consider. Can you have a different asset allocation in that particular part of the plan, or does it have to be the same all the way across?
As far as I know, you can spread it out across any of the anything you'd want to, or any of the options that are available within the plan.
So, if you really want to try to make the very most of this, the post-tax money, you might want to make that a little riskier. In other words, have that more in stocks than in bonds, because that is going to grow tax-free, where the pre-tax money is going to grow, but when you take it out, you'll have to pay tax on it. So if you want to game it even more, ramp up your stock holdings in the post-tax money, that $17,000, because it gets the tax-free growth. But I think that's a great idea. Absolutely.
Very good. I appreciate you guys' take on it. Thank you very much.
Thank you, Adam. Happy holidays. Our phone number again, 855-935-TALK. Let's go back to the phones where Chris standing by, joins us now on the program. Hi, Chris.
Hi. So I've recently rebalanced my all my funds, and I spread it evenly across 25% across 4 different funds: Vanguard Balanced Index, Vanguard Mid-Cap Index, Vanguard Total Bond Market, and Vanguard Total Worldwide Stock Index. Therefore, when I look at my mix, my asset allocation, I would expect to see in their little pie chart that 25% is in bonds. However, when I actually look at it, it shows 34.5%, even though I have almost exactly the same amount in each of those 4 funds. Are some of the non-bond funds have a slush fund inside of them where they are holding 13%?
No, here's the deal. Did you just say Vanguard Balanced Index?
Yes.
That is 40% bonds.
Oh, okay.
That's why your allocation is 34. I think you're making this more complicated than it needs to be. One, get rid of balanced and just use the total world, and get rid of the mid-cap too. Just use the total world and the total bond index. If you want to add a little bit of risk that has shown additional historical return, put a modicum into the Vanguard Small Cap Value Index.
So then you'd have a 3-fund array. You could have whatever part you want to have in bonds just in one fund, which I do agree it's confusing if you have it more than one. And then, and this is, by the way, we recommend stock funds and bond funds separately if you're going to have more than one fund. You could own the balanced index fund if you want just one fund. It's 60-40. It's easy to do it that way. But I like what Don says here. You have your U.S. and international, basically large cap stocks. You supplement that with maybe 20% in small, and then the rest of it in bonds to give you the balance. I think that's a good way to go.
Yeah, and if you want that 25% bond allocation, you're going to have to do it the manual, the 2 or 3 fund way.
Okay, the 34% doesn't bother me. But I just wanted to know, I'm a numbers guy, and I was running this in a spreadsheet, and it didn't add up for me. There's not an advantage of doing does the total world also include the mid caps?
Yes.
Or not?
Yes, it does.
I was just trying to go for maximum distribution across different categories.
You will have truly the entire global market, with the exception of a few little penny stocks, lightly traded things. But the reason we suggest tossing in small cap value is because it is one asset class that has shown historic, and I do mean large historic, outperformance over decades. So you throw a little of that in, even though you have small cap, in the total stock fund, you don't have much of it. And we think it's better to overweight small cap value than to overweight mid cap, which is what you're doing right now.
Chris, thank you very much for your call. And again, Don is exactly right on it. And that's why our friend Paul Merriman, by the way, tells people to have a balanced type fund and then add in the small because you have so little exposure to it. By the way, small has been the market leader here for about the last month and a half, small value up over, I think, 22%. So you want to own that. Those premiums get paid in a very short period of time. Often we don't see it coming, and you want to take advantage of it. Let's see if we can get to another call here. Tori joins us on Talking Real Money. Go ahead.
Yes, hi. I was just wondering, I have about $2 million all of it in Roth IRAs and the total stock market index fund, and I have about $500,000 in a 401 rollover. I was just wondering if it would be in my best interest to roll that all into the Roth IRA and eliminate the rollover and paying the capital gains tax. Say it again.
Well, you'd be paying more than capital gains tax. You'd be paying regular income.
$500,000.
Yeah, I don't know anything about your tax. Well, okay, first of all, let's just go. What we're trying to say is going back. On the $500,000, should you want to put that into a Roth IRA, you would be paying regular income tax rate to do so.
Right.
It's just they're just looking at that as income. So I don't know anything about your tax situation. Generally, that's not a good idea because you're paying a lot of tax right now. If you already have $2 million in Roth, well, you have a lot of post-tax money. So again, I don't know why you'd want to run out and do that other than, hey, now all my money's in Roth. Great, but you gave up 30% of the $500,000 to the government for the pleasure of doing that. I don't think that's generally a good strategy.
I think having a mix of taxable and non-taxable retirement money is probably the smarter way to go at this juncture because you're getting close to retirement. You're going to pay a lot of those taxes. You're probably not going to save it in the long run. Thanks for the call. 855-935-TALK. Call anytime.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
Your guides to a really great financial future. Tom and Don are talking real money.
If you have a quick, easy question, we can answer it anytime at this number, 855-935-TALK, 855-935-8255. You can call 24/7. But if you have a more complex situation and you need some help, you don't know where to turn, you're afraid of getting ripped off, well, don't despair. We got fiduciary advisors that are committed to helping you with no obligation, at no cost, and with no high-pressure sales pitch. Just set up an appointment. They're free at vestory.com, vestory.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.